Welcome to The Explainer. Today, we are putting on our expert investment analyst hats. Our goal? A rigorous, no-holds-barred financial audit of a high-growth, unprofitable medtech company, using some of the absolute most classic valuation frameworks in the investing world. We're looking at Alphatec Holdings, ticker symbol ATEC. We're going to take all their recent financial data and systematically run it through the gauntlets created by Warren Buffett, Benjamin Graham, and Peter Lynch before building our very own discounted cash flow model. Get ready, because we're about to see if the math actually justifies the hype.
Here's our agenda for the audit. Number 1, ATEC Company Snapshot. 2, the Buffett Lens. 3, the Graham Lens. 4, the Peter Lynch Lens. 5, DCF and alternative models. And 6, synthesis and final verdict. Let's jump right in.
Section 1, ATEC Company Snapshot. So, to establish exactly what Alphatec Holdings does and where the stock currently stands, we can see ATEC is currently trading right at $9.30 a share. This gives the company a market cap of roughly $1.36 billion. Now, they operate in the healthcare sector, specifically focusing on innovative medical devices and solutions for spine surgery. But to really understand this $9.30 price tag, we have to look under the hood. The underlying clinical narrative here is frankly incredibly strong. They're boasting 17% year-over-year surgical revenue growth, hitting $178 million, which is being driven by a 21% jump in case volume and some rapid procedural adoption by a ton of net new surgeons. Basically, they're perfectly positioned for this massive, multi-billion-dollar shift of spine procedures moving over to ambulatory surgery centers. But there's a catch. Their recent quarter saw a massive stock drop because their total revenue missed targets. Why? Delays in installing their super expensive EOS imaging hardware. It's like the razor is working beautifully, but the heavy, expensive blade is causing a major drag.
Section 2, the Buffett Lens.
Okay, there is an immediate, glaring tension when we apply Warren Buffett's framework. While Buffett looks for a strong economic moat, super consistent earnings, high return on equity, and easily manageable debt, ATEC presents a vastly different picture. Now, they certainly have a budding economic moat with a really sticky procedural ecosystem, right? But ATEC's reality is a negative net income of about $34 million in Q1 alone, a staggering negative 461% return on equity, and a debt-to-equity ratio sitting at nearly 32 times.
And it gets tougher. Buffett bases his intrinsic value calculations on owner earnings, which we usually proxy with free cash flow. As this direct quote from their Q1 earnings shows, their current quarter free cash flow was negative $11 million. Because we literally cannot establish consistent, positive owner earnings, Buffett's framework just stops right here. He wouldn't even attempt to calculate a buy price or a margin of safety for a business burning this much cash with this much debt. For Buffett, this is a clear, definitive avoid.
Section 3, the Graham Lens.
So moving on to Benjamin Graham, the father of value investing and Buffett's mentor, we get our next strict framework. Graham wanted large, stable, dividend-paying companies. Spoiler alert, tech gets absolutely crushed here. Their $1.36 billion size is simply too small. Their financial condition fails due to that high debt. They have zero earnings stability, no dividends, and a negative price-to-earnings ratio of negative 9.5x. It is a clean sweep of failures on Graham's defensive checklist. But as expert analysts, let's actually run Graham's famous intrinsic value formula anyway, the square root of 22.5 times earnings per share times book value per share. ATEC's Q1 EPS is negative 22 cents. Their book value per share is negative 3 cents. We have to make an explicit assumption here. While multiplying two negatives mathematically gives you a positive number, conceptually, Graham's formula absolutely requires positive earnings and positive equity to denote actual value. Because both are structurally negative, the formula just fundamentally breaks. There's zero margin of safety. Graham wouldn't touch this stock at any price.
Section 4, the Peter Lynch Lens.
Okay, let's pivot entirely away from the value trap, because things get fascinating when we look at growth justification. Peter Lynch categorized companies into different buckets, and ATEC perfectly fits his fast grower category, maybe even with a touch of turnaround thrown in. I mean, they're demonstrating 14% total revenue growth and an even more impressive 17% core surgical growth. Lynch loved companies that were growing top-line revenue fast, especially in specialized industries where they're actively stealing market share.
And here is where Lynch's math actually works in ATEC's favor. Lynch popularized the PEG ratio, price to earnings divided by growth. With ATEC's current metrics, their forward-looking PEG ratio sits at an incredibly low 0.3x. In the growth world, anything under 1.0 is considered a fantastic value. Plus, they just refinanced their debt out to 2031, which saves them $6 million annually in interest and gives their $140 million cash pile plenty of breathing room. Now, while Lynch usually preferred low institutional coverage, the fact that 11 out of 11 analysts rated a buy shows some serious momentum. So under Lynch's criteria, this actually triggers a speculative buy.
Section 5. DCF and Alternative Models.
Next up, we're building our own discounted cash flow and looking at some alternative revenue multiples to see if the underlying math can justify Wall Street's aggressive optimism. To build a DCF, we forecast free cash flow, calculate a terminal value, and discount it all back. But since ATEC currently has negative cash flow, we're making an explicit analyst assumption here. We are fully modeling a successful turnaround. We're projecting future FCF breaking even and turning positive over the next 5 years, anchoring our entire model on management's reaffirmed 2026 guidance of $882 million in total revenue. Then, we apply a perpetual growth method for the terminal value.
When we run a sensitivity analysis, comparing our discount rate against terminal growth, a really clear picture emerges. Check this out. To reach Wall Street's average price target of $16, you have to assume a highly optimistic 8% discount rate and strong terminal growth. In our base case, using a standard 10% AACC and a 3% terminal growth rate, the fair value sits right at $13 per share. But notice that if you demand a stricter 12% return, the fair value drops to around $9.60. That's essentially exactly where the stock is trading today at $9.30. The market is literally pricing in a 12% discount rate perfectly.
Now, because traditional PE ratios are completely useless for unprofitable companies, we have to use alternative models, like enterprise value to sales. ATEC's enterprise value is roughly $1.89 billion. Divided by their trailing sales, their EV to sales ratio sits at 2.41x. When you compare that to industry peers that often trade at 4 or 5 times sales, 2.41x is highly reasonable. It mathematically shows that at $9.30, you really aren't overpaying for their top-line revenue growth.
And this underlying math, it's exactly why Wall Street analysts are so aggressively optimistic. The absolute lowest analyst target is $11. The average is $16, and the high target is an incredible $24. Every single one of these sits comfortably above the current $9.30 share price, projecting massive upside. If, and it's a big if, the company can just manage its debt and execute on those hardware installations.
Section 6. Synthesis and Final Verdict.
All right, let's bring all of this together and give our final verdict on this complex medtech play. We obviously have conflicting signals, which is exactly why we run multiple models in the first place. Here's the final scorecard. If you're a strict value investor following Warren Buffett or Benjamin Graham, your fair value is practically non-existent. The verdict for you is to run away, sell, or avoid. But if you're a growth and momentum investor following Peter Lynch, that 0.3x PEG ratio absolutely screams buy. Our base case DCF suggests a fair value of $13, which triggers a buy-in at today's $9.30 price, and Wall Street is emphatically calling it a strong buy at $16.
Ultimately, it all comes down to how you weigh these factors. The strengths are undeniable, right? 17% surgical growth and massive surgeon adoption in a market heavily shifting toward ambulatory surgery centers. But the risks are equally stark. A very heavy debt load, delayed capital installations that literally caused a 32% single-day stock drop, and structurally negative margins. Blending all these insights together, our final recommendation is a speculative hold or a cautious buy. You are entirely betting that their clinical adoption and revenue growth is going to outpace their messy balance sheet.
So we'll leave you with this final thought to ponder as you look at your own portfolio. Is Optec's aggressive, hardware-driven footprint strategy really worth the risk of their current financials? Can they survive the capital bet long enough to become the absolute spine market leader of the future? Thanks for joining us on this deep dive explainer. Keep analyzing, and we'll see you next time.